The Scottish economy is flirting with recession. That's the key conclusion of our latest economic commentary. We saw at the end of last year the latest data point that we have from the Scottish Government that the GDP picked up a little bit to 0.2%, but the revised figures showed that growth had contracted by minus 0.1% in the third quarter of last year. And then moving into the first quarter of this year, for which we don't have output data, there were severe problems in the Scottish labour market. 53,000 jobs were shed, the biggest loss of jobs since early 2010, and the unemployment rate rose to 6.2%, which is quite a large gap compared with the UK rate of 5.1%, now 5%. It's the biggest gap between Scotland and the UK since 2004. So what's going on here? Well, basically what we're seeing are certainly some of the consequences of the fall in the price of oil, which both affected the oil supply industry, but it's having a more pervasive effect on the supply of services in the Scottish economy. So that's one area. But it's more than that, because we're seeing also our trade position is worsening. Second half of last year, manufacturing trade was negative. There's been a decline for some time in the value of exports since about 2014. So this is a major drag on the economy. We also have ongoing austerity, government austerity, which again is a drag on the economy. But that's affecting the UK as well as Scotland. We're seeing also investment being affected by the fall in the price of oil, but also the prospect of the uncertainty surrounding the Brexit referendum next week has led to many companies to postpone investment plans. And in the data, there's been a drop in investment. What we're seeing then is that the economy is largely being driven by household demand. And the problem, though, is that the bases for household demand to continue to grow are relatively weak. All these job losses will start to feed into household incomes, and that will feed into household spending. We see the effect of various other factors impacting on household spending. The slowdown in the growth of house prices will affect asset values, which will also affect spending. The growth of real wages is very, very weak, and that affects spending. So fundamentally, we're relying on household spending. Household debt is very, very high. We're not sure this is sustainable. And so there's a real fear here that this may start to unravel and we may see another recession occurring. However, it's not wholly bleak, because the surveys for April suggest that the economy is picking up a little bit, and that from the low in the first quarter. So we might escape the recession, but it's not certain. We do have this problem, though, that if we do vote to leave the EU, then the uncertainties become really significant. And we haven't included any of that in the present forecast. And if we do vote to leave the EU, we will clearly have to revisit these forecasts. So against this background, we've revised our forecast down fairly considerably, from 1.9% to 1.4% this year. And we've revised next year's forecast down slightly, from 2.2% to 1.9%. That's in terms of the growth of output. We're forecasting for the first time 2018, and we have growth of 2%, which is basically to say that we should get back to trend by then, but of course nothing is certain. Our job creation numbers are still positive, but have reduced quite considerably from our previous forecast. And we're predicting that unemployment will rise even further to about 6.9% by the end of this year. Will fall again next year to about 6.7%. But by and large, we're in a world where unemployment now is considerably higher than we were forecasting some time ago. And basically, the gap between Scotland and the UK is widening on all fronts. So here we have a situation where we could be on the brink of another recession. We hope that we're not, and we're predicting that we will just escape it. But if we do vote to leave the EU, then all bets are off. and we enter a new world.